Let's bring in David Marchant, the CIO of Canada Life Asset Management. David, good to see you. Very interesting markets over the last week. I'd be interested in your opinion on what you think that tells us about the third quarter and how risk-on attitudes are.
Yes, good morning. I think the market participants are, debating the outlook for growth and the impact that is having on inflation. And I think it's that sort of push and pull on inflation that is driving markets to a large extent at the moment. And in my view, I think aggregate demand is clearly very strong. Purchasing managers indices, I think back in June it was something like 62. 50 is the boom bust level. Good expansion. We've got savings very high in the UK, so something like 20% savings ratio at the end of March. There's a lot of pent-up demand out there, and we're really looking at GDP growth this year, perhaps the order of 77%, and that's going to take us back to pre-pandemic levels potentially by the end of the year, notwithstanding slightly dull numbers out today. On top of that, we've got quite a few shortages. Some of that's obviously pandemic-induced supply chain shortages. But you're also seeing shortages of labour, chefs, drivers, hospitality staff in general. And on top of that, we've just seen a huge monetary stimulus, quite rightly, through the pandemic to keep the economy going. And we've got to think about how that gets unwound. And if you check the economics textbooks, and really all the ingredients there are for growing risk of inflation. And there are lots of examples out there at the moment. You've seen oil, the highest level since 2014, wheat similarly strong, copper, 50% up on pre-pandemic levels. And there's lots of examples, chip prices, containers, second-hand cars, and so on. So I think central banks have a really delicate balancing act, how they don't want to derail the recovery, but equally they don't want to risk inflation. I think that's what markets are having to deal with. I know the comments are that this is transitory, and maybe that's the case, but I think the risk that it isn't,
David,
is not really reflected in markets. You've got 0.6% yield for 10-year UK government bonds, and in Germany they're negative. So I don't think those risks are really reflected at the moment.
David, is there any contradiction in the yield we get now on the 10-year US Treasury with that broader inflation argument?
I think there is. I think this is a global issue. I think that, as I say, the risks that inflation isn't controlled, that it does start to accelerate, is not reflected in where government bonds or bonds generally are trading.
Sorry, David. I think what you're saying, and again, I don't want to put words in your mouth, but you're saying the central banks are wrong in their benign assessments to longer-term inflation. From what I hear you saying is that they've basically been too blasé about the transient base effect nature of the inflation we're seeing at the moment. And again, going back to your quote, all the economic textbooks say that the evidence is there for a sustained period of higher inflation. So what you're saying is the central banks are wrong, yeah?
I think it's dangerous to say that. I think they were clearly, central banks did a very good job through the pandemic in supporting the economies. We had an entirely appropriate expansion of QE around the world, and they did a great job of doing that. But the result of that is that we have a further increase in debt levels. We'd only just got to a stage where we got the levels of debt from the financial 07-08 crisis back under control. But we're now seeing debt to GDP levels rise up to around about 100% for the UK. So a lot of debt out there. The central banks, quite rightly, concerned about derailing the recovery if they risk raising interest rates too soon. But the cost of that is that inflation could be a little bit higher. Now, maybe if we can see sort of 3-4% inflation, it's temporary. That's not too damaging, and indeed it reduces the real value of debts. But I think there are serious risks out there that they could be wrong.
When you talk about consumers, and I think in your own notes, huge levels of savings yet to be deployed, plus the fact that what appears to be a labour shortage. And you mentioned chefs. I read probably the same article as you yesterday talking about sous chefs, where they're just across the board. You cannot get chefs in a lot of hospitality as well. So you're going to get higher wages. There are less jobs out there, well, being filled, and indeed you've got a huge pool of savings to be deployed. The good side of this is that the economies are going to go gangbusters when people get more money and go out and spend more money, though, yeah?
I think that's right. I mean, we've heard from the Bank of England in the past talk of a coiled spring recovery, and I think we're having exactly that at the moment.
David, then let's talk about allocation at the moment. Based on your worldview, where should we be encouraging our audience to look?
Well, I always caveat this by saying, when you're investing, you've got to diversify, you've got to take a long-term view, don't get distracted too much by short-term noise. But at the margin, I think, given where we are on the risk of inflation not being fully reflected in bond markets, I think I have some concerns about longer dated bonds. So my preference is for shorter dated bonds, preferably corporate bonds, so you can get the extra yield. And I think they're protected by the fact that we're going to see a very good corporate profit recovery this year. And being shorter dated, that does give you less volatility if interest rates start to rise. Other than that, I think you want to be focusing more on assets that could get some benefit from inflation. So, whilst equities have done phenomenally well, I think profit growth is good, and there is some inflation protection there too. So I think they're okay. But one interesting one, I think, is actually the property sector, which has been a big laggard. We've had a lot of uncertainty around retail and challenges on the high street. There's uncertainty about whether people go back to the office. But this is an asset class that's lagged everything else virtually, and we are looking at yields of 4 or 5% in that market, and I think that's also got some inflation protection there as well. So I think that's quite an interesting area to start thinking about.
Don't you think, though, CRE is a very dangerous place to dip your toe at the moment? I mean, you talk about offices. I look at the high street. I'm sure near where you live as well, David, you've got the same vacancies going up as well. Yes, you've got a 4 or 5% yield as well. And I know there are certain areas of CRE, such as warehousing, which are going through the roof. But by and large, offices and retail real estate, I think they're terrifying places at the moment, aren't they, David?
There are certain areas which still look pretty frightening. I would say that whilst you don't get a good return without taking a certain amount of risk, and there's certainly risk in property, but the market is depressed. We are seeing valuations stabilise even in retail. Now, I'm not sure I'd be piling into high street retail. There's still some challenges, lots of vacancies, as you mentioned, but we are seeing some stability in valuations of things like shopping centres. On the office side, you're getting a lot of announcements. A number of the investment banks have been telling their staff to get back into the office. Some of the accountancy firms as well. And I think a lot of over the last 12 months or so, attitudes have changed from I'm happy working at home forever to actually I'd like to go back in the office and meet some people. So I think offices actually have been reasonably stable. And I think that's a reasonable prospect for the coming 12 months or so.
Nice work, David. Have a good weekend. Thanks for your time. David Marchant, CIO, Canada Life Asset Management.